If you're only buying QQQ because it's been the obvious way to beat the market over the past decade, you could be headed in the wrong direction. There are opportunities in the market right now that have the potential to beat QQQ over the next decade. Now, guys, I know QQQ feels safe because it's worked for a long time. It represents innovation, scale, dominance, and growth. It has a great story behind it, and the numbers have backed it up. And when something works year after year, our brain starts to confuse familiarity with safety. But in markets, safety often gets expensive when expectations get too high. Now, this video is not anti-tech. I'm not saying QQQ is bad. Quite the opposite, actually. This video is about something much more important. Understanding where expectations are already baked in and when the market might be mispricing what's going to happen next. Because markets don't pay you for what already happened. They pay you for what's mispriced going forward. That's why the biggest long-term returns usually don't come from buying what everyone else already agrees is great. They tend to come from areas where sentiment is poor, expectations are low, and most investors have already given up. So today, we're not trying to guess the best ETF for 2026. And if you were hoping from the title that we were going to help you crush it this year, I need you to stay with me because there's a lot of lessons to be learned. Our goal isn't one great year. It's to help you outperform the market over the next 10, 20, or even 30 years. And if it's not even outperforming, it's understanding and sleeping better at night, knowing what you're buying. What we found is that some potential opportunities right now are hiding in housing, energy, small caps, and gold. Areas where excitement is low, expectations are muted, and the setup could look very different the next market cycle. Today, I'm going to walk you through 4 ETFs that almost no one is excited about right now and explain why that lack of excitement might be exactly where the opportunity is. Now, what I want you guys to remember is this is not a go out and buy these 4 ETFs video. I'm not here to do that. I'm here to teach a way of thinking, a process on how to think about things and investments. This is not the channel where you can get, go buy this, go sell this. That's not the way to learn how to invest. I'm here to teach you how to fish. So let's set the table up properly. QQQ is a wonderful ETF. It has been dominant for a reason. It captures mega cap innovation, network effects, global scale, and extraordinary profitability. When QQQ is working, it feels unstoppable. The risk with QQQ isn't that technology stops mattering. The risk is concentration and expectations. A small group of companies right now drive a huge percent of index returns. That works beautifully as long as growth stays exceptional and multiples stay elevated. But once expectations get stretched, the bar for future outperformance gets much higher. And that brings us to the real question going into 2026 and beyond. What happens if the next cycle isn't dominated by the same narrow group of winners? Guys, look at history. It's never year to year to year the same guys winning, the same stocks winning, the same sectors winning. So what happens if inflation reaccelerates instead of disappearing? What happens if rates stay volatile? What happens if growth continues, but the market stops rewarding it with ever-expanding multiples? Guys, these things have happened many times in history. Go look at Amazon. Amazon stock in 2000 to the low of 2002 fell 96%. But every single fundamental metric went up from that same peak of stock price to the low. That's the point here. Fundamentals can get better while stock price lags. And when that shift happens, the winners are going to change. Historically, beating a high expectation index like QQQ over a multi-year period usually comes from a few mechanisms. It comes from multiple expansion in sectors that were hated and written off. What that means is a sector before that was selling for 9 times earnings is now selling for 20 times earnings. That is what they say. That's what they mean when they say multiple expansion. It comes from earnings recovery in cyclical areas that were punished during tight financial conditions. Think about it like housing. In 07, 08, 09, 2010, housing was absolutely crushed. People were losing money or not making as much money. And then a recovery started. It comes from mean reversion after long stretches of underperformance. Think about things like gold, maybe. It comes from macro tailwinds like stabilizing rates, commodity cycles, or supply constraints that were structural there. And very often, it comes from consolidation, where weaker players get absorbed, competition becomes rational, and survivors gain pricing power. Guys, we always talk about this. Anybody can make a lot of money during a booming economy and a booming stock market. But when the problems start to hit, the companies that weren't able to survive will get swallowed up by their competitors. This is what this video is about. It is never going to be on this channel about predicting one perfect year, but it's about identifying potential undervalued opportunities from the way I see it. I'm here to project onto you what I believe, and you could accept it, you could reject it, whatever it is, it's a way of thinking. Now, before we get into those 4 ETFs we're analyzing today, let's take a step back and explain something super important for the newer investors watching. What is an ETF? Well, it's an exchange-traded fund. It's basically a basket of investments that you can buy just like a stock. That basket might hold stocks, bonds, gold, or other assets. So when you buy an ETF, you're buying a small piece of everything inside that basket. It's an easy way to get exposure to a whole sector or theme without picking individual stocks. Now, here's why ETFs are great for a lot of people. They trade exactly like stocks. You can buy and sell them anytime the market is open for exactly the market price you're quoted. And they tend to have lower fees than mutual funds. Mutual funds usually trade at the end of the day and can have hidden fees or higher expense ratios. ETFs generally tend to be very simple. They tend to be simpler, cheaper, and much more transparent. Now, if you're brand new to ETF investing and have never heard of dollar cost averaging before, or you want to reiterate those tools in your head, you're missing one of the most important ways to build long-term wealth. Click the link in the description to download my free strategy guide and learn why this simple approach is extremely hard to beat, and why you using this simple approach will beat those Wall Street millionaires and all those Harvard graduates. So, how do you find a good sector ETF that might be undervalued? Well, first, you got to look for sectors that have long-term staying power, things that people or businesses will still need 5, 10, 20 plus years from now. That could be stuff like energy, healthcare, any sort of technology. Second, make sure you understand how this sector makes money. If you can't explain how it's going to make money, you will not be able to explain or see how it's going to lose money. So in my opinion, that's when you just skip it. Next, check if companies in that sector are actually profitable and have solid cash flow. Sectors with strong, steady companies usually hold up better when the market gets rough. Then, look at the price. If a sector has been ignored or beaten down, but still has strong fundamentals, it might be undervalued. We love it when we see company prices going like this, but fundamentals going like this. That is the perfect situation for a value investor. Now, finally, think about risk. Some sectors bounce up and down a lot, while others move more slowly. A strong sector ETF gives you growth, financial strength, and a clear role in your portfolio. Now, back to QQQ for a minute for our new investors. QQQ tracks the NASDAQ 100. That means it holds the 100 largest non-financial companies listed on the NASDAQ. Think Apple, Microsoft, NVIDIA, Amazon, Meta. Think big tech names. But also has some everyday companies that you wouldn't think are in that whole ballpark. QQQ has an expense ratio of only 0.18%. That means for every $1,000 you invest, you're paying $1.80 a year in fees. That's really low, especially considering that a typical mutual fund is 5 to 10 times greater than that. And that adds up in the long run. That can eat up half your portfolio over a 30 or 40-year period if you buy into those managed high-fee mutual funds. So QQQ at 0.8% is pretty low, but it's not free. And remember, that free gets taken out of the fund's performance automatically. So it's important to compare that when you're analyzing different ETFs. Now let's talk about something most people missed in 2025. Some ETFs actually beat QQQ and actually by a lot. QQQ had a big year with a 20.77% return, but there are some sectors that beat it. The iShares US Technology ETF, IYW, outperformed QQQ with a return of 25.2%. It is purely tech. So when money poured into AI, cloud infrastructure, and enterprise software, IYW captured more of that upside without the drag of the non-tech sectors that are included in QQQ. If QQQ is a smoothie with mixed ingredients, IYW is straight on berries. When tech booms, that purity pays off, and it pays off big. Then there's XAR, a defense sector ETF that returned around 70%. Why? Global military spending jumped. Governments signed long-term contracts and defense companies delivered stable, non-cyclical earnings. While most people were watching big tech, defense was quietly crushing it. And don't forget GLD, which tracks the price of gold. Guys, it returned 67%. In a year full of inflation concerns, geopolitical tension, and falling real rates, gold became a safe haven. Central banks bought in, investors got nervous, and GLD soared. What did Bitcoin do? I thought that was a safe haven. Everybody, Bitcoin bro, was like, oh, this is the safe haven. It was down, guys. The point is, these ETFs outperform QQQ by targeting more concentrated trends. Now, this doesn't mean you chase what just worked, but it's a reminder that QQQ doesn't always win. Cycles shift and smart investors adapt. Okay, now with that foundation laid, let's dive into 4 ETFs that could give QQQ a real run for its money over the next 5 years. And one quick disclaimer I need to let you know. These sectors can and will be volatile. That's why understanding what you're buying and the price you pay really matters. Again, we're not here to tell you, go buy these. We're here to teach the way in which we think about things. ETF number 1, XHB is often called a home builder ETF. That's way too narrow. This thing gives you exposure to the entire housing ecosystem, builders, suppliers, home improvement companies, material manufacturers, and so much more. So it's not just about buying a house. It's all about the stuff that makes housing tick. Now, the expense ratio is higher, 0.35%, which means you're paying $3.50 a year for every $1,000 invested. It's almost double the price of QQQ, but you're also getting exposure to a totally different part of the market. Now, right now, housing feels like a total disaster for most people. They see high mortgage rates, frozen real estate market, and they say, why would I ever touch that? But here's the thing. Housing didn't crash like everybody thought it would when rates went up. But activity has definitely slowed down. And there are sectors and areas in the market that are definitely significantly lower. There's a big difference there. Transactions in 2025 were incredibly low. Just over 4 million homes sold that year. That's historically low, but prices didn't collapse. Why is that? Because supply is still tight. People aren't selling unless they have to. Inventory is low, and mortgage rates, while high, have actually come down quite a bit. So when you hear that rates dropped from 6.93 to 6.16 over a year, you might think, who cares? But in housing, that's a big deal. A tiny rate move can make a monthly payment suddenly much more affordable. And that's why sales actually picked up at the end of 2025. People didn't stop wanting houses. They just couldn't pull the trigger at 7 to 8% mortgage rates. XHB is interesting because inventory still remains low. We're still sitting at around 3.3 months of supply, which is well below the 5 to 6 months that represents a balanced market. So prices are staying up. Small rate drops can unlock transactions because housing is highly emotional. People want to feel like they're not making a mistake, and stable rates help with that. On top of that, tons of homeowners still have mortgages under 4%. They aren't moving unless they absolutely have to, which tightens up existing supply even more and supports new builds and renovations. And when people can't move, what do? They're going to renovate. That means more spending on remodeling, furniture, appliances, stuff that still benefits companies within XHB. XHB has done much worse than QQQ recently, losing about 0.7% in 2025, while QQQ gained almost 21%. And the year before that, XHB went up 10%, while QQQ jumped up nearly 26%. That tells us that housing stocks are a little unloved right now, while most investors are crowded into QQQ, which could potentially create opportunity where no one's looking. So is this a short-term play? I don't play many things short-term. For me, I'm looking at longer-term bets. The market thaws and the housing activity comes back to life. And when it does, my guess is that companies in XHB stand to benefit. But again, guys, I'm going to repeat till I'm blue in the face. We are not here to predict what's going to happen this year or next year. Now, ETF number 2, XLE. Now, this represents U.S. energy, and the holdings are large, established players like Exxon and Chevron. These companies are pumping out tons of oil and natural gas and tons of cash. Guys, the expense ratio is only 0.08%, which means it's super cheap. 80 cents per year fees on every $1,000 invested, one of the lowest cost ETFs out there. In 2025, U.S. oil production hit a record high, 13.6 million barrels per day. Natural gas was over 107 billion cubic feet per day. This is not a dying industry. It's running at full speed. And these companies aren't doing what they did in the past. They're not just growing for the sake of growth. It's much more about discipline now. They are returning money to shareholders instead of wasting it. For example, Exxon had a quarter with almost $15 billion in operating cash flow and gave nearly $9.5 billion of it back to investors through dividends and buybacks. That's huge, guys. Even when oil prices are just okay, say $65 a barrel, these companies can still make a boatload of money. If inflation comes back or stays sticky, energy companies benefit. They price their products in real time. U.S. companies are sending more LNG abroad, which links their profits to global markets. And with fewer players in the game, there is more pricing power and fewer bad decisions being made. Yes, oil prices can crash, and energy stocks can be volatile. But this sector is misunderstood, and misunderstood often equals mispriced. ETF number 3, IWM. Now, this one tracks the Russell 2000, which includes small U.S. companies. These aren't the huge mega cap giants like Apple or Microsoft. These are smaller, often riskier, but potentially higher reward businesses. The expense ratio is 0.19%, so still relatively low. That's just under $2 a year for every $1,000 invested. Small caps have lagged behind the S&P and NASDAQ for some time. But that underperformance has created an opportunity. When rates were rising, small caps got crushed. They have more debt and less pricing power. But if rates stop rising or come down, that pressure comes off very quickly. Now, IWM hasn't done as well as QQQ over the last 5 years. While QQQ more than doubled, IWM is only up about 30%. That big gap shows investors have been focused on big, safe companies that have great stories and have mostly ignored the small ones. But now, small caps are much cheaper relative to both history and earnings expectations, and that creates opportunity. If the economy improves or interest rates fall, IWM could bounce back in a big way. A small increase in revenue can lead to a big increase in profit because their cost structures are so tight. Big companies love buying small ones when the price is right, and that could happen more if credit loosens up. This isn't about small caps being amazing. It's about conditions improving just a little. When expectations are this low, you do not need perfection to win. Now, GLD tracks the price of gold. This is the 4th ETF. Not gold mining stocks, not futures, just gold. Gold is different than anything else we've talked about. Gold doesn't pay dividends, doesn't generate cash flow, it just sits there. Now for me, I don't consider gold an investment. I don't consider itself an investment asset. The expense ratio on GLD is 0.4%, the highest of the group. That's $4 a year for every $1,000 invested. But remember, gold behaves differently, and part of what you're paying for is access to a hard asset. Gold exists to protect against things the rest of the market isn't pricing in very well. Things like inflation, currency problems, geopolitical risk, and uncertainty in general. When inflation-adjusted interest rates fall, gold gets far more attractive. That's because you're not giving up income by holding it. Big institutions have been loading up on gold. That changes the supply and demand picture over time. When people worry about the dollar or other currencies, gold becomes the backup plan. Gold can zig when everything else zags. That makes it a useful part in a diversified portfolio. Plus, there are thousands of years of track record, and there's other uses to gold besides being able to use it as a currency in effect. Now, gold won't always outperform. In fact, it can drop 20% in a heartbeat. It plays a different role. It doesn't need growth to win. It just needs some doubt. And as I mentioned earlier in this video, GLD beat QQQ in 2025. And with higher inflation and the US dollar continuing to be devalued, GLD could have a good track record over QQQ over the next several years, especially based on valuations for QQQ as of right now. Now, guys, these are all thoughts of mine. I'm here to teach a way of thinking. I'm here to show you what I think. Apply this to your own world in the way you see fit. Each of these ETFs offers a different kind of exposure. XHB is about housing thawing from a freeze. XLE is about cash flow from a disciplined energy sector. IWM is about small caps rebounding from years of underperformance. And GLD is potentially about protection and uncertainty. These are never guarantees, but they're potential opportunities. If you take a long-term view and focus on process, not the hype. Now, here's the honest truth. Most of you shouldn't be chasing sector ETFs like these anyhow. Yes, they're interesting. Yes, they're fun. There's potential. But if you're following a principle-driven investing strategy, your focus should be on building wealth slowly and safely over the long term. That means dollar cost averaging, which is buying consistently over time, no matter if stocks are up or down, and sticking with a broad-based S&P 500 ETF like SPY or VOO. It is a better, way better plan for over 95%, actually over 99% of investors. Now, there is a way to beat the market using 3 of these ETFs, including QQQ that we mentioned in this video, based on history. So click the video on your screen. I'm going to walk you through the exact 3 ETFs that if I would buy if I was brand new to investing. Thank you for your time.